All right, let's jump right into this explainer. Today, we're putting on our financial analyst hats and running Renasant Corporation straight through the legendary Warren Buffett value investing framework. We're taking the raw data from their Q1 2026 earnings release and transcript, and we're going to process it exactly how a top-tier value investment committee would. Here is our game plan for today. First, business and economic moats. Second, deep financial statement analysis. Third, rigorous valuation models. Fourth, the margin of safety. And finally, our definitive Buffett-style verdict. Starting right off with Section 1, Business and Economic Moat. At its core, Renasant is just a classic, totally understandable business. It's a 122-year-old regional bank operating down in the Southeast with about $27.1 billion in total assets. They make their money in the most traditional way possible, capturing the spread between customer deposits and loans, and then layering on some fee income from wealth management and mortgages. Right out the gate, it easily passes that first and honestly often the hardest test for value investors. It is a fundamentally understandable business. Now, I'm reading their economic mode as narrow. Look, banking is an incredibly competitive industry, but surviving for 122 years, that builds some seriously deep, localized brand equity. Combine that with the naturally high switching costs for their over $22 billion in core deposits, and you've got a solid hedge. Plus, the long-term prospects look super stable here, with management consistently guiding for mid-single-digit loan and deposit growth. And you really have to listen to CEO Kevin Chapman's candor on the earnings call. He is absolutely not sugarcoating the macro environment. He points directly to volatile consumer cash flows and rapid spikes in fuel costs as the exact reasons they're maintaining elevated credit loss reserves. This kind of blunt honesty, especially when you pair it with their highly shareholder-friendly capital allocation, that checks a massive box on our list. We are clearly dealing with able and honest management. Okay, moving right along to Section 2, Deep Financial Statement Analysis. Let's see the numbers. The income statement trends here are, frankly, fantastic. Net income absolutely surged by 112%, hitting $88.2 million. That's up from $41.5 million just a year ago. Adjusted earnings per share jumped 41% year over year to 93 cents. And a lot of this was driven by successfully squeezing out those cost savings from their recent First Bank shares merger, which drove their efficiency ratio down to a really impressive 55.7%. But for us value investors, the absolute crucial metric is adjusted return on tangible equity. And Renasant's just leaped from 10.3% up to 16.36%. A return on equity comfortably sitting above 15%. That is the exact hallmark of consistent high returns on capital that the Buffett framework absolutely demands. On top of that, their balance sheet is a fortress right now, boasting regulatory capital ratios way above minimums and a cash position north of $1.2 billion. Let's talk capital allocation, because this number is staggering. Management repurchased $75 million of their own stock at roughly $39.50 a share in Q1 alone, and then scooped up another $25 million in April. They are aggressively shrinking that share count, while at the same time raising their quarterly dividend to 24 cents a share. The share count is actively falling, which is literally music to an owner's ears. Now, if we're doing a strict Buffett analysis, we have to calculate owner earnings. Traditionally, that's net income plus D&A minus maintenance CapEx. But those specific line items aren't standard in a bank's earnings release. So we're going to make a logical assumption as analysts here. We'll use that net income of $88.2 million and treat their $8.1 million credit loss provision as a proxy for the maintenance costs they need to sustain that loan book. Which brings us to Section 3, rigorous valuation models. Time to do the math. Let's kick this off with a base case discounting cash flow model. Because these quarterly filings don't give us multi-year historical cash flows or beta, we explicitly assumed a 10% cost of equity for our discount rate. For growth, we just mapped management's own mid-single-digit guidance, so let's call it 5% for the next 5 to 10 years, and then tapering off to a 2.5% terminal rate to match long-term GDP. Run that through, and this base case DCF yields an implied intrinsic value of roughly $52 a share. Even in a pessimistic scenario, we hit $45, while an optimistic one stretches all the way to $60. Next up, Benjamin Graham's classic intrinsic value formula. We take that adjusted Q1 EPS of 93 cents and annualize it to get $3.72. We plug in that same 5% expected growth rate. Now, the current AAA corporate bond yield isn't explicitly in the text, so we're assuming a standard 4.5% yield to act as Y in the formula. And when we run that specific math, the Graham formula spits out an intrinsic value of $67.27. That is a massive number compared to current market reality. It strongly suggests the broader market is just severely undervaluing this bank's true earning power. If we glance over at multiples, and keeping in mind the documents don't give us a broad peer group to compare against, annualizing their earnings gives us a PE ratio of just 9.7. They're trading at 1.44 times tangible book value. If we assume a totally normal historical PE for a healthy regional bank is somewhere closer to 12, the relative cheapness here is pretty remarkable. You are essentially paying bargain bin prices for a bank that is generating a premium 16% return on tangible equity. If the multiple just expanded to fair value, the stock would sit around $45. But here is where it gets really fun. Running a reverse DCF is incredibly revealing. If you plug their current price of $36.13 backward into our model, it tells us the market is pricing in literally 0 to 1% future growth. Think about that. The market is completely ignoring management's mid-single-digit pipeline and their recent hiring spree of revenue producers. Finally, looking through a dividend discount lens, their newly raised 96-cent annual dividend is practically ironclad. They have a pristine dividend payout ratio of just 24.47%. That leaves massive retained capital. We're talking over 75% of their earnings to plow right back into organic growth, strategic M&A, and, of course, those heavy stock buybacks. So, blending our models together, we see the DCF at $52, the Graham formula way up at $67, and standard multiple expansion putting it around $45. If we triangulate all of these, we arrive at an average, highly probable intrinsic value of roughly $54 per share. All of which brings us to the most important concept in value investing, Section 4, the margin of safety. With the current share price sitting at $36.13 and our calculated intrinsic value up at $54, well, you can see the disconnect. We have a significant, highly protective gap between what the business is actually worth and what it costs to buy a piece of it today. That gap gives us a 33% margin of safety. This comfortably exceeds that strict 25 to 30% threshold that value investment committees usually require to protect against downside risk and any unforeseen accounting errors. We have our safety net. All right, committee, it's time for Section 5, the final Buffett-style verdict. The verdict is a resounding buy. Renasant Corporation gives us a localized, narrow moat with highly capable capital allocators steering the ship. Management is literally acting like owners here. They're allocating capital perfectly by aggressively buying back their own shares at $39, while the market is happily offering them to us today at $36. They're delivering 16% returns on tangible equity, they're actively managing expenses post-merger, and we get a 33% margin of safety. This is exactly the kind of setup the Berkshire framework hunts for. But I'm going to leave you with this final thought to chew on as we wrap up this explainer. Warren Buffett famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. At $36 a share and generating a 16% return on tangible equity, is Renasant a wonderful business at a fair price or a fair business at a wonderful price? Something to think about.